Hi, I'm Angela Wittern. I want to welcome you to Accounting 201. I am going to share my screen and then we will move on to the problem here. I've got an Excel document here I wanted to share with you in regards to CALE. We are doing problem number 13 in chapter 10. And I want to illustrate the accounting for bonds issued at face value. We will start first when we issue bonds. That means the company will be receiving cash for the amount of the bond at face value at $350,000. To balance this account out, then we will credit or increase our bonds payable account by the same amount, $350,000. Got the right amount of zeros. Okay, so we issued our bonds in January 1st, 2017. Now, the end of the year, we want to show the accrual of interest. So we will be debiting interest. There you go, expense. And this is the formula I use to determine the interest for a full year. So we've got the face value of the note at $350,000. Our interest rate is 8%. For a full year would be $28,000. So I will record that interest expense, and it's the end of the year, so this will now be a liability, an interest payable account, and that will also be $28,000. Okay, C, it says payment of interest on January 1st. So now we've recorded the interest accrued, but now we actually need to pay the interest. So we are going to decrease our interest payable, and we will be decreasing, let me see, am I in there? Yeah, cash. And when we calculated it, we will be using the same amount, $28,000, for decreasing or debiting our interest payable, and then we will be pulling it out of our cash account. Our last entry now happens 20 years later in the year 2037. So January 1st is asking us to redeem the bonds at maturity. So we're going to be paying off these bonds at face value, and we are to assume that the interest has already been recorded. So we just have to write off the face value of the bond. So we are going to decrease bonds payable. Oh, I was not paying attention. Let's see, get back down here. There you go. So we will be decreasing bonds payable for the face value of the original note 20 years before at $350,000. Okay, so we're paying that money out. So that means we're going to be crediting cash and clearing this off of our books for $350,000. So this shows the life of the maturity. We would be doing this every year, accumulating interest and then paying that every year. But to actually redeem the bond, it just takes a simple face value interaction in our journal entries. And I think that covers it. Hopefully this is clear and that everyone did well on their exam this past week. Thank you, and we will see you next time.